The world of finance is filled with complex theories and counterintuitive phenomena. One such phenomenon is Siegel's Paradox, a puzzling concept in international finance and deals with exchange rates and future expectations. This paradox, identified by economist Jeremy Siegel in 1972, challenges our intuitive understanding of how currency values should behave over time. In this video, we'll unravel the intricacies of Siegel's Paradox, exploring its origins, its underlying assumptions, and its implications for international trade and investment. We'll delve into the mathematical models and economic theories that attempt to explain this paradox, and we'll consider its real-world impact on currency markets and financial decision-making. Whether you're a seasoned economist, a curious investor, or simply someone intrigued by the complexities of global finance, this exploration promises to challenge your assumptions and broaden your understanding of exchange rates and their unpredictable nature. And who knows, perhaps by understanding Siegel's Paradox, you'll gain valuable insights that could inform your own investment strategies and financial decisions. Siegel's Paradox, a concept in international finance, presents a puzzling scenario where uncertainty about future prices can lead rational consumers to make seemingly counterintuitive choices. This suggests that individuals might temporarily exchange their preferred goods or currency for less desirable ones, with the intention of trading back to their preferred goods once prices stabilize or become more predictable. To illustrate this, imagine a situation where Americans believe that the euro will appreciate against the dollar in the future. In this scenario, they might decide to invest their dollars in euros even though they prefer to consume goods priced in dollars. Their rationale is that by holding euros, they can potentially benefit from the expected appreciation and then convert their euros back into dollars at a more favorable exchange rate, ultimately purchasing more American goods than they could have initially. Likewise, Europeans who anticipate the dollar appreciating against the euro might invest their euros in dollars, even though they prefer to consume goods priced in euros. This creates a paradoxical situation where both Americans and Europeans seem to gain monetary value by trading their preferred currency for a less desirable one. This apparent paradox arises from the ambiguity of the term monetary value in the context of uncertain future prices. While the initial exchange might seem to involve equal monetary value, the expected future appreciation of the exchange currency creates the potential for a perceived gain. However, it's important to note that Siegel's paradox is not a true paradox in the logical sense. It's a phenomenon that can be explained by rational economic behavior under conditions of uncertainty. The decision to temporarily trade away preferred goods or currency is driven by the expectation of future gains, even if those gains are uncertain and depend on the unpredictable fluctuation of exchange rates. Understanding Siegel's paradox is crucial for investors and traders operating in international markets. It highlights the importance of considering future price expectations and the potential benefits of diversifying investments across different currencies. It also serves as a reminder that even seemingly irrational decisions can be explained by rational economic principles when we factor in the complexities of uncertainty and risk. Economist Fisher Black illustrated Siegel's paradox with a simple yet thought-provoking example involving apples and oranges. Imagine two countries, one where consumers prefer apples and another where they prefer oranges. Let's say the current exchange rate between these two countries is 1-to-1, meaning one apple can be traded for one orange. However, there's uncertainty about the future exchange rate. It could either double to 2-to-1, meaning one apple would be worth 2 oranges, or halve to 1-to-2, one orange would be worth 2 apples, with equal probability. Now suppose an apple consumer from the apple country trades one apple for one orange with an orange consumer from the orange country. The apple consumer seems to have made a good deal. They've given up one apple for an orange that could be worth 2 apples next year, giving them an expected value of 1.25 apples. Likewise, the orange consumer also seems to have benefited. They traded one orange for an apple that could be worth 2 oranges next year, resulting in an expected value of 1.25 oranges. At first glance, it seems like both parties have gained from this exchange, a seemingly paradoxical outcome. However, this apparent surplus is not a true economic gain. It's a result of the uncertainties surrounding the future exchange rate and the differing preferences of the consumers. The apple consumer values apples more than oranges, so even if the exchange rate shifts in their favor, they are still giving up their preferred good for a less desirable one. Likewise, the orange consumer values oranges more than apples, so they are also making a sacrifice, albeit one that could potentially be offset by a favorable exchange rate. This example highlights the complexity of decision-making under uncertainty. While both consumers appear to gain monetary value in the short term, their long-term satisfaction depends on the uncertain future exchange rate and their individual preferences. Siegel's paradox demonstrates that rational economic behavior can lead to seemingly counterintuitive choices when faced with uncertainty and fluctuating exchange rates. To further illustrate the intricacies of Siegel's paradox, let's consider a more detailed example involving two wines, an American wine and a German wine. Imagine an efficient market where these wines currently trade at 1-to-1 exchange rate. However, there's a prediction that in the next month, one of the wines will become trendy, doubling its value relative to the other wine. There's a 50-50 chance that either wine could become the trendy one. In this scenario, there are two types of consumers: loyalists and trend followers. The loyalists only drink wine from their own country and are indifferent to trends. The trend follower, on the other hand, doesn't care about the wine's origin, only its trendiness. The American loyalist, who only drinks American wine, might surprisingly choose to hold German wine instead. This seemingly counterintuitive decision is based on the expected value of the German wine. Since there's a 50% chance it will become trendy and double in value, and a 50% chance it will remain the same, the expected value of holding the German wine is 1.25 American wines. Likewise, the German loyalist would prefer to hold American wine, as it also has an expected value of 1.25 German wines. In this case, the gains from Siegel's paradox are real, as the loyalists stand to benefit from temporarily trading away their preferred wine. However, the situation is different for the trend followers. If a trend follower holds American wine, they might reason that trading it for German wine would be beneficial, as the expected value of the German wine is higher. However, this logic is flawed. Since the trend follower doesn't care about the origin of the wine and only its trendiness, they are essentially gambling on whether the American wine will become trendy or not. If the American wine becomes trendy, they would have been better off keeping it. If the German wine becomes trendy, they would have been better off trading. In the end, their expected value remains the same, and they haven't gained any real advantage by engaging in the trade. This example highlights the importance of considering individual preferences and risk tolerance when analyzing the potential gains from Siegel's paradox. While it can lead to real benefits for those with strong preferences, it may not always be advantageous for those who are indifferent to the underlying characteristics of the goods or currencies being traded. While the examples involving wine and apples and oranges may seem simplistic, Siegel's paradox has practical applications in the real world, particularly in the realm of international finance and investment decisions. Fisker Black, after analyzing scenarios similar to the apple-orange example, concluded that investors should not necessarily hedge all their currency risk when investing overseas. This means they might not always convert their investments back into their home currency immediately, but instead hold on to foreign currencies with the expectation that they might appreciate in value over time. However, other researchers caution against applying Siegel's paradox too broadly. They argue that the decision to hedge or not hedge currency risk depends on various factors, including the source of the exchange rate uncertainty. For instance, if the uncertainty is due to differences in inflation rates between countries, with the assumption of purchasing power parity, the idea that exchange rates should adjust to equalize the purchasing power of different currencies, then the gains from Siegel's paradox might be illusory. In many situations, however, Siegel's paradox can indeed provide a rationale for investors to embrace some level of currency risk. If there's a reasonable expectation that a foreign currency will appreciate against their home currency, it might be beneficial to hold on to that foreign currency for a period of time, potentially reaping greater returns when they eventually convert it back. The application of Siegel's paradox to investment decisions highlights the importance of considering future price expectations and the potential benefits of diversification across different currencies. It also underscores the need for careful analysis and understanding of the underlying factors that drive exchange rate fluctuations. In the complex world of international finance, Siegel's paradox serves as a reminder that even seemingly counterintuitive strategies can be justified by rational economic principles when we factor in the complexities of uncertainty and risk. A different perspective on resolving Siegel's paradox involves the use of mathematical tools, specifically the weighted geometric mean of future exchange rates. Researchers K. Malahi Kari and P. Safari suggest that this approach can help determine a fair and mutually beneficial exchange rate in situations where future prices are uncertain. The weighted geometric mean takes into account both the potential future exchange rates and the probability of each rate occurring. By incorporating these factors, it provides a more accurate reflection of the expected value of currency, taking into account the inherent uncertainty of future market conditions. In the apple-orange example, using the weighted geometric mean would result in a fair exchange rate of 1-to-1. This means that one apple should be traded for one orange, ensuring that neither party gains an unfair advantage due to the uncertainty surrounding the future exchange rate. This this method can be extended to more complex scenarios involving multiple currencies and a wider range of possible exchange rates. By calculating the weighted geometric mean, traders and investors can arrive at a mutually agreeable exchange rate that accounts for both the potential risks and rewards of different investment strategies. The reciprocity function, another mathematical concept introduced by Malahi Kari and Safari, can further refine this approach. However, in most cases, the reciprocity function can be simplified to the unit function, meaning it doesn't significantly alter the outcome of the calculation. The use of the weighted geometric mean in the reciprocity function provides a more rigorous and mathematically sound approach to resolving Siegel's paradox. It offers a way to navigate the complexities of uncertain future prices and make informed decisions about currency exchange and investment. By relying on these mathematical tools, traders and investors can minimize risk, maximize potential gains, and ensure that their transactions are fair and equitable for all parties involved. We've journeyed into the realm of international finance and uncovered the curious phenomenon of Siegel's paradox. We've explored how uncertainty in future prices can lead to rational individuals to make seemingly irrational choices, temporarily trading away their preferred goods or currencies for less desirable ones in the hopes of future gains. We've delved into the examples of apples and oranges, wine, and currency exchange, illustrating the potential benefits and pitfalls of this paradoxical behavior. We've also examined alternative approaches to resolving the paradox, such as using the weighted geometric mean and the reciprocity function, which offer more mathematically rigorous solutions to the problem of their exchange rates under uncertainty. While Siegel's paradox may seem like a theoretical curiosity, it has real-world implications for investors and traders operating in international markets. By understanding this phenomenon, we can gain valuable insights into the complexities of decision-making under uncertainty and the potential risks and rewards associated with different investment strategies. If this exploration has sparked your interest, I encourage you to delve deeper into the world of international finance and explore the various models and theories that attempt to explain exchange rate fluctuations and their impact on economic behavior. And who knows? Perhaps by understanding Siegel's paradox, you'll gain a new perspective on the financial world and develop strategies that can help you navigate the complexities of global markets and make more informed investment decisions. Thank you all for watching. My name's The Big Why. Don't forget to drop a like, and if you're new to the Why Not family, a follow. And I'll catch you guys in the next video.